Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some bulletin board hero stocks on Thursday, August the 7th. I'm starting off with Bowleven, where I would suggest that quite a few traders scratching their heads in recent weeks over the price action. Obviously, we had this spike to the upside through 45 pence, which is effectively a bull trap event, and then this rather nasty slide back along the path of the 200-day moving average, currently at 38 pence. The risk here, and there was always a suggestion that the shares wouldn't be able to move on or move up until the unfilled gap to the upside at the beginning of June at 33.5 pence was filled, and this looks like the scenario which is on tap here. So possibly, if you're not involved in the situation at the moment, you'd be looking to buy any dips towards that gap floor. Otherwise, the momentum buy signal, which has always been in place, or has been in place for the last couple of weeks, would be to wait on an end of day close back above 40 pence to shake off the breakdown that we've seen since the middle of June. Moving along to Doriemus, and here we have a stock which has also been quite fiddly, let's just say, in the recent past. We had the floor here after the range peaks around 0.25 pence in June. 0.12 was the floor at the beginning of July, and we've been sort of retesting that to start August. There is a hint of an RSI support line here towards the 35 level, and a hammer daily candle off a rising trend line from May gives us this sort of neutral or consolidation pattern within a triangle over the past, which has been in force over the past couple of months. Probably, if you're cautious, you'd wait for an end of day close above the 50-day moving average at 0.15 pence and the triangle top at the same level before going long. Obviously, if you're aggressive, you'd say that the hammer candle that we've seen on Wednesday was the floor for the stock, and also a rebound or a double bottom versus the July support. So consolidation, but possibly that is now over and will give way towards a retest of the range highs at 0.25 pence over the rest of August and going into September. Finishing off with what is arguably the stock of the moment, an update from the company, Quindell, yesterday, which suggested that things are looking more stable on the fundamental front. On a technical front, we have that idea matched by a bear trap rebound from below £1.50, which was the floor in June. There was a double bottom there, and low yesterday at £1.38 delivered quite a strong hammer candle on the daily chart, with a close at £1.70, which is quite a significant turnaround, and also suggests that we've seen a selling climax, which has stopped out all the bulls below the £1.50 floor, and we'll now see the shares head back higher. Still plenty of resistance there, obviously, from the 50-day moving average at £2.22 and an extended resistance line from April running towards £1.97. So at the moment, probably the best way here would be to be buying the stock on any dips towards £1.50, which one would hope would be new support, and then look for a rebound towards the £2 zone as a best case scenario over the next couple of weeks. But obviously this is a very volatile situation, and still after yesterday's move, the situation is rather wide open in terms of what may happen next, but narrowly favouring from a technical point of view a rebound back towards £2, even if that is not the end of the recent breakdown or the post-April breakdown for the shares. That's it from me. More updates at spreadbetmagazine.com.